Both headwinds and cracks are starting to show within the U.S. economy. Consumers are starting to push back. Just in recent weeks, we saw the likes of McDonald's as well as Starbucks showing that consumers are pushing back on price hikes, starting to think a little bit more about how they spend those precious dollars they earn. In other news, we have also seen cracks in the job market start to come to fruition. Unemployment is on the verge of crossing over 4%. Job openings have fallen off. Average hourly earnings growth was above 6% at the start of 2021, and that has nearly been cut in half today. There are reasons to be concerned, not in a full panic right now, but concerned about the direction of the U.S. economy. Does that mean we need to pull all of our money out of the stock market? Absolutely not. I often say it a lot. I prefer time in the market rather than trying to time the market. As such, in today's video, we're going to take a look at 3 core positions, 3 ETFs that every investor should consider buying today with this economy starting to slow down. And before we take a look at those 3 ETFs, do me a huge favor. Click that like button down below. Subscribe to the channel as I truly appreciate it. And let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 3 ETFs worth buying today. Beginning with ETF number 1, which is the iShares High Dividend ETF, stock ticker HDV. If you're on the search looking for growth, then this is probably not the ETF for you. A lot of ETFs that track the S&P 500 or popular ETFs like QQQ are heavily weighted toward technology, which has been the leading sector over the past 12 to 18 months. That's not the case when it comes to HDV. Now, if you're looking more for a core holding, some more stability for your portfolio to go along with high yield dividends, this is going to fit that bill. When it comes to the size of this ETF, it has assets under management of a little over $10 billion. And over the past 12 months, the ETF is up 15%, and over the past 5 years, closer to 45%. Again, not crazy returns, but stability is key, especially if we're heading towards an economic slowdown. It's important when developing a diversified portfolio that you're not overexposed too much to one particular sector. Technology has been the high flyer in the past 12 to 18 months, but if we go back to some dire times back in 2022, just a few years back, is the last time we saw the S&P 500 heavily under pressure. In fact, it was down nearly 25% on that year. As you can see here on the chart, HDV saw a total return of a positive 7%. This is why you need core positions in your portfolio that will be a stronghold regardless of economic activity. Now let's take a look at the dividend. Not known much for dividend growth, but as you could probably tell by its name, it focuses more on higher yield dividend stocks. The ETF has a dividend yield of about 3.3%, and over the past 5 years, it has increased its dividend at an average annual rate of just 3.4%. Now let's take a look at sector exposure for the fund. And at the top, you can see energy accounts for roughly 25%, consumer staples 19%, healthcare about 16.5%, utilities at 9%, and technology, the 5th largest sector, at about 8.5%. Very defensive sectors at the top. Now let's jump to the top positions within the ETF, where you see the likes of ExxonMobil, Chevron, Verizon Communications, Johnson & Johnson, AbbVie, Philip Morris, Merck, Coca-Cola, PepsiCo, and Altria. In total, the fund has 81 positions, and the top 10 account for 52%. So given that, a larger position or a larger exposure to those top 10, you want to be comfortable with those stocks before investing. And that leads us to ETF number 2, which is the Vanguard Dividend Appreciation ETF, stock ticker VIG. Of the 3 ETFs that we're looking at today, this is probably the one I'm most excited about. It offers a unique blend of growth opportunity as well as solid dividend growth. And if you know me, I'm a big believer in the power of compounding. And when you put these two things together, it just puts the power of compounding into overdrive. VIG has assets under management of about $90 billion. And over the past 12 months, the ETF is up nearly 20%. Over the past 5 years, it is up nearly 80%. So as you can see, much stronger returns from this ETF, which makes sense because when you see the sector breakdown, this ETF has a much higher exposure to the technology, faster growing type of companies. Let's first, though, take a look at the dividend. VIG offers a dividend yield of 1.8%, much lower than the first ETF, HDV, that we just looked at. However, it has a 5-year dividend growth rate of 8.5%, nearly triple what we saw from HDV. VIG, as it says in its name, dividend appreciation, is more focused on dividend growth and less on yield. The other exciting part is that growth is increasing, dividend growth that is, with a 5-year CAGR of 8.5% as we just saw, but look at that 3-year CAGR. It is at 11.4%. Now let's take a look at the top sectors within VIG. At the top, you could see technology at 22%, financials at 20%, healthcare comes in at third with 16%, followed by industrials at 12%, and consumer staples rounding out the top 5 at 11%. A complete mix-up in sectors that we saw from HDV, which takes much more of a defensive approach. VIG, a little bit more growth conscious. Now let's jump into the top holdings for VIG, which at the top you can see Microsoft and Apple, followed by Broadcom, JP Morgan. So those top 4 we did not even see on HDV. The 5th largest position, Chevron, followed by United Health, Visa, MasterCard, the Home Depot, and Procter & Gamble. So in terms of follow-up from HDV, there's only one carryover. In total, VIG has 343 total positions, and the top 10 accounts for 29%. Just looking at those sectors and looking at those top 10 holdings, you can see the difference between a defensive approach with HDV and much more of a growth-conscious approach when it comes to VIG. Plus, you get the added benefit of faster dividend growth. And that leads us to the third ETF on our list, which is SCHD, or the Schwab US Dividend Equity ETF. Did you think I was really going to do a top ETF video without including the likes of SCHD? Now, I know a while back I did do a video focused on the reconstitution that took place with SCHD. And although I was a little bit bummed out, we have to take a step back and say SCHD has been creating this fund the same exact way throughout its entirety. So who are we to question it today? Now, it appears like it's taking much more of a value approach, but it's really not doing anything all that different than it has in years past. So we do have to understand that and trust the process overall. Undoubtedly, though, it is fair to assess that dividend growth is likely to slow. That was one thing I loved about SCHD. It had a dividend yield that was higher than high dividend focused ETFs. It had dividend growth that was stronger than dividend growth focused ETFs. But I believe with the likes of Broadcom coming out and the likes of Merck, 2 top positions within SCHD of last year, both coming out of the ETF, dividend growth is likely to slow in the coming year. In terms of size, SCHD has assets under management of $56 billion. Over the past 12 months, the ETF is up 18%, and over the past 5 years, up roughly 80%, much more in line with VIG, which we just looked at. Again, if we fall into slower economic times, SCHD is going to perform quite well. It doesn't have that overexposure to the likes of technology or communication services, which always makes it a great complement to those faster growing ETFs you might own, like an S&P 500 or like a QQQ. Let's have a look at the dividend. And this ETF has a good combination of high yield and strong dividend growth, but again, I do expect that dividend growth to slow in the coming year. Currently, the dividend yield sits about 3.5%, with a 5-year dividend growth rate looking back of about 12%. Here's a look at the top sectors, which you see at the top: financials with 17% exposure, healthcare with 15% exposure, consumer staples at 15%, industrials at 14%, and energy at 13%. As you can see here, no technology or communications anywhere near the top 5. You have to go quite a ways down the list until you see technology and communication services, which, even given that, they don't have much exposure. Now let's jump to the top positions within SCHD, where you see Texas Instruments, Amgen, Chevron, Lockheed Martin, PepsiCo, Pfizer, the Coca-Cola Company, UPS, Cisco Systems, and Verizon Communications rounding out the top 10. In total, SCHD has 103 positions, with the top 10 accounting for roughly 41%. So there we just looked at 3 ETFs, all relatively different from one another. You had HDV, which is more focused on higher yield dividend stocks. You had VIG, which is strictly more focused on dividend growth, and SCHD, which can kind of give you a combination of both. It has a higher dividend yield and it can give you a little dividend growth, although it is slowing from the tremendous results it's had in the past few years. So if you do, in fact, believe a slowdown is coming, then you probably want to lessen your growth exposure. But again, it goes back to the phrase I like to say often: I prefer time in the market over trying to time the market. Down in the comment section below, let me know which of these 3 ETFs are you most comfortable investing in right now. And if you haven't done so, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.